Good morning, everyone. Today we'll be talking about portfolio diversification and how it relates to Hur Fund. I'm Arthur Hur, and you're watching Live Futures Trading with Hur Fund. So I got a comment on yesterday's video, and thank you for sending that in. Feel free to email me. Better yet is to comment on these videos, because then everyone can see the questions. And if you have a question, then that means someone else has a question. And at the same time, everyone else can see the answer. And so it will be hopefully helpful for everyone, and helpful for me to know what I should talk about, because right now this is still new for me, and thanks for bearing with me and joining me in this journey. Okay, so the question was in regards to the fact that we've got 30K and we have one position on, we have one straddle on crude oil. And the traditional or sort of recommended stance or opinion is that you need to have multiple positions on in many different underlyings. And my opinion of it is, yes, that's true. However, the way that we're playing this strategy, it is actually a pretty high risk position. And so in order to match the amount of risk that you're putting on, you need to be able to have enough powder, dry powder, to make sure that you can manage that risk. And so, yes, as much as I would love to have positions on in like 10 underlyings, the fact that we're using leverage, the fact that we're using leverage on top of leverage, options on top of futures, means that we want to be incredibly judicious in terms of what we're putting on and how much we're putting on. And the classical mistake that I feel like a lot of people have made is that you put something on, it works, and so you're like, oh, give me more of that. Let's do it. Let's scale it up. And that might work in certain situations in life, but it doesn't work in the markets, I don't think. And especially if you're trading this short premium style, just doesn't work. So this is what I'm doing. You are more than welcome to do what is comfortable with you and what works for you. However, and I'll talk about this in some of like the actual edited videos that I create, but there are like various time horizons that I think work for people like us, where we actually have an edge over time, as long as we don't let our egos and our opinions and our greed get in the way. And that's to think about things in terms of three sort of buckets of time. So long lengths of time. Putting money in a 401k. You know, there's sort of like Warren Buffett passive investing sort of strategy. Whereas, you know, stock market goes up 7, 8, 9% on average every year. After 40, 50, 60 years working at a company, you put money into the IRA, into the 401k, or every year you put a couple $100 or a couple $1,000 into like a Roth IRA or something like that, and you just put it in an index fund, or even worse, a mutual fund, and then, you know, eventually when you retire, it'll be something. I mean, and as long as you're just consistently putting money into it, it'll be more than if you just left it in the bank. That definitely makes sense. But I would assume that if you're watching this video, that you're not the type of person that's content with not being able to withdraw from your account until after you're 65, 70. I mean, come on, let's be honest. You know, like we don't live in a world where people work at companies for 40, 50 years and then have pensions. I mean, unless, you know, God bless you, you are a federal worker or whatever it is. I mean, you know, like the corporate America has not embraced that. So, you know, we live in a gig economy. We live in a world where people are, and especially young people, are pretty itinerant. So yeah, that's that. And then so that's the long term, right? Yes, almost guaranteed to make money, more than lose money, unless you get 2008, 2020, and you're like, I'm liquidating, and then you sell at the lows. Short term, day trading, swing trading, probably gonna lose money over time. You'll make a little bit of money. You'll make a decent amount in the beginning. Maybe you'll make a lot in the beginning, but then egos get in the way. You scale up. You end up kind of putting on more and more risk to get more and more gains in order to get more and more dopamine hits. And then all it takes is one mistake, and then you're done. And likewise, what I actually was doing with Trade Hur was doing a sort of kind of high frequency trading light type of like algorithm or strategy. And the thing is, it might work in certain situations. I think where it really benefited was on the rolling day. But the thing that I realized after looking at a couple of expirations is that you just can't anticipate when that is. When a big firm, I think they intentionally are not rolling whatever it is X number of days before expiration. So it's and that was the thing. It's like one day you just be like, oh, how come it was unprofitable, losing on average like a couple $100 to a couple thousand, and for several number of days, and then all of a sudden it spikes up, and you're like, where'd that come from? And it was like, oh, well, it must have been a big dealer just kind of rolling their trades. But then after they're done rolling, it's like, that's it. you missed the move already. So I would see these like paper gains and be like, all right, well, I can't really benefit from it anymore. So it's a tricky game, and the thing is, when you're dealing with that type of really short-term, compressed time situation, like we just don't have an edge. We don't have the data speed. We don't have the execution speed that the market makers, the Citadels of the world, really have. The only place where I feel like you have an edge over time, without having to just do the boring way, is in this kind of medium-term range, a couple weeks out. That's where you can really kind of benefit over time. So that's what we're doing. A couple other announcements. Yesterday I had my daughter on and everything, and I'm sharing more of my life than I ever wanted to or anticipated to. So there's that. But right now this is still a new show. It's the third one. And I am still trying to figure out like a regular schedule. I would hope that eventually I could land somewhere between when the market opens and 10 a.m. Eastern Standard Time. Right now it's about 10:16. So that's what I'm hoping for in the future. It might not happen until maybe like September or so, when I have a little bit more of a regular schedule. But as I'm able to record, it'll probably be in the morning, early or mid to late morning. So you can always catch the stream after it's recorded. It seems like that's how people are finding it right now. Eventually, I will have like a set time, so you'll be able to tune in at a certain hour, certain minute, and we can have a little more consistency that way. Okay, let's get into things. Screen share. Oh, let me go to it up. Just one moment. Screen share. Is that? That's not right. Stand by. Screen capture. Video. Video capture device. Screen capture. Video capture device. Oh, yes. Sorry about this. Use buffering. How come it's not showing me my screen? This. that. Let's make a new one. Using the software is a little new for me, so I apologize. Hopefully you're catching this asynchronously and can just skip ahead. But if you're tuning in with me live, which is, maybe one person, you've already clicked on something else, then I apologize. Screen capture, display capture, display. Okay, I think we're good. All right, and then let's get the video capture on. There we go. Okay. All right. I think we're back. Okay. So today, let's look at our position. $100, 105. We're finally in the green after 3 days of kind of like nothing. I mean, and in the end, 105. Not great. Not terrible. But hey, I'll take a win over negative P&L. Actually, last night it was up to 165, and I was looking at it overnight. Kind of hovered around that 170 range. But the market or the crude oil is starting to creep up again. It seems like it keeps wanting to go to 74 and either stalls out or I'm not really sure, but things are working well. Another thing is someone mentioned that I should probably put my account number in privacy mode, and that makes sense, but it doesn't allow me to show my net lick, and so I appreciate the feedback, but if anyone wants to hack into my account, please put more money in than is in there instead of taking it out. Let's just make that promise. So let's talk today about portfolio diversification. So I really appreciate that comment yesterday, because the prevailing wisdom is that you should put on multiple different underlyings that are like kind of uncorrelated, bonds, stocks, commodities, what have you, or metals and digital metals, real metals, things of that nature. And yeah, that's true. We just don't have the capital. I feel like the argument, and let's just think back to first principles here, right? Like why would you want to have a portfolio diversification? It's so that things move in opposite directions, and you don't have too much risk in any given underlying. And it's kind of like an old school way of thinking, like, oh, I'm gonna allocate 60% to equities, 40% to bonds, because if the stocks sell off, then the bonds will go up, and if the stocks go up, then the bonds might go down, or whatever it is. And it just kind of assumes that it's sort of like that long-term passive investing kind of strategy. What we're doing here is, yeah, of course we'd like to have on S&P futures, NASDAQ futures, Russell, bonds, notes, gold, I don't know. Yeah, maybe like Ethereum or like mini BTC or something. I don't know how liquid those options trade. But what's most important is to be able to protect yourself from moves. And if you had on all these positions, what happens with volatility is that when you have a crazy event, everything goes berserk. So if you had on all of these positions, they would all be crappy, right? Especially all of your index, your equity index positions, ES, NQ, RTY, they would all go down the crapper together. They'd all go in the same direction. So I mean, that's not portfolio diversification for me. Portfolio diversification is just like literally trading S&P. That is diversified across the entire market. I mean, that's about as diversified as you can get. So if you trade just the S&P and have a good strategy and can defend it, right? And where the diversification happens is in how you deal with outlier moves. And those outlier moves the outlier move in one position, when it gets crazy, is they're all going to be outlier moves. So how do you deal with the outlier moves? That's the whole reason why I'm doing this stream, why I'm publicly trading, is to show that this strategy can work in real time using my own money, and let's see how it plays out. I know that there are a lot of people that talk on YouTube and whatever it is, and they're self-proclaimed financial gurus, and they say that they know what the market's going to do, or they say that they're going to show you everything about every strategy and everything. Yeah, I've been through a lot of that. I've seen a lot of gurus, kind of spout stuff. And the thing that I want to stress to you, I don't know if I mentioned it before, but if someone is selling you the fact that they know what the market is going to do, why would they ever need you to pay them a subscription to find out? I mean, they should just be like the richest person in the world if they knew what stocks were going to do. No one knows what's going to happen. And anyone that wants to sell you on a vision that they do is either dumb or they're just scamming you. So that's why I'm here. Okay. Second of all, obviously I'm using tastytrade, and tastytrade's great. I've watched their programming over many years, and the thing is, what they want to do is they want to be able to teach you everything. And that's good. You should learn everything. But after you learn everything, you should find out what works for you. So this is what I'm trying to do right now. Do I have anything else to talk about? Well, eventually we'll get into what happens when our break-evens are breached. So right now what I have, where is it? Alerts. Okay, so $6 above and $6 below. Nice even number instead of like 643 or whatever it is. Pretty much, if it goes past 78.50, we're in a world of trouble. So we'll have to do something, even if it's 648, 93 or something like that. No, we will adjust when it gets to 78.50, and we'll adjust when we get to 66.50. And briefly, what it is where we want the stock to trade, or the whatever it is, the commodity to trade within this range, right? And maybe like we're going left to right, right? So it's going this way, right? So we want to stay inside this range. If it goes up here, right, 50-50, will either be profitable or unprofitable. We need to increase our probability of profit, right? So we need to just recenter everything. But how do you recenter everything while still maintaining an edge, right? Like right now, we have a probability profit of above 50%, which is good, which is what we want. Normally, like the sort of, I don't know, the tastytrade way is like you put on a wide, 1 standard deviation, pure extrinsic, junky call and put, right? And then it goes up, you start rolling up your put, and it goes down, you start rolling down your call, and it goes up, and you start rolling down, and then you end up with a straddle. And your probability of profit is like this. You're already down on everything. You didn't collect enough. There's no intrinsic delta inside your actual position, so that when the thing moves out, like you're just stuck. And so what do you have to do? You just have to keep rolling and rolling and rolling. I don't like that. Just don't like it. It just doesn't work for me. So I'm gonna try to show you something new, where you don't have to like take off positions. You just you keep the same position on. You adjust it. You start. It's the inverse, okay? So, and this is the other thing. Someone was saying like, oh, isn't the position you're putting on kind of like an iron condor? It's like, yeah, it's kind of like an iron condor, but it's just the fact that like an iron condor, you're defining your risk, right? But do you really want to put on like that type of risk reward? I mean, you're pretty much guaranteeing that when you lose, you're going to lose big, and anything that you stand to gain is really hard to get to. because you can't manage these trades like the way that they work in tandem. When you're buying that theta, it just doesn't work the same way. And all I can say is that you just have to sell as much meat, you have to sell as much extrinsic value of an option if you want to really benefit from data decay. So what I have over here is the way that these two guys work, right? The way that the extrinsic on these two is exactly the same. I mean, not exactly, but more or less. If you put on a wide strangle, 1 standard deviation, 2 standard deviations, 1.5, whatever it is, those extrinsic values are going to kind of waffle around. And when you actually have a move, you're not going to be able to collect enough from the opposite side of what your winner is from what you're losing from the losing side. Let me just keep it at that. I know I'm rambly, and I've just got so much going on in my head, and it's the reason why I started this channel, was just to like offload some of this stuff, because I just get caught up in so many ideas and things I don't want to talk about. I'm only going to assume, and I'm going to try over time to be more concise, to get to the point, and to be better as far as sharing my strategy, my experience, my lessons, and hopefully it's helpful for you. If it's not, then just do the opposite. Just do exactly the opposite of what I'm doing. Right now it's working. We've got 125, which is not much to write home about, but it's 3 days. Let's see how this plays out over time. And thanks for watching. I'll see you tomorrow.